In this video, traders, we're going to look at how to get exposure to the NASDAQ with these selection of ETFs, depending on what you're trying to achieve. Stay tuned. Hey traders, warm welcome to you. All right, so ETFs can be a very powerful way of getting exposure to an underlying group of stocks. In this case, we're going to talk about the NASDAQ. So how do you get exposure to the NASDAQ? Now, normally you might buy NASDAQ futures, you might buy spread bet, you might buy CFD, but ETFs, there are different ones out there that will allow you to get exposure to the NASDAQ, whether you're bullish, whether you're bearish, how aggressive the exposure you want to get is, all these kind of different things. So let's look at each one of these individually and see maybe what your trade thesis was and which one you might pick for this. So the first thing to look at, guys, is the biggest one out there, which is the Qs, QQQ. Now this is basically just mirrors the NASDAQ. So the NASDAQ goes up 1% in the day, the NASDAQ index goes up, NASDAQ 100 index goes up 1% during the day. The Qs are going to go up by 1% during the day. They've got 87 billion assets under management. The code for this is QQQ, and the expense ratio is 0.2%. It's worth noting, actually, guys, that the expense ratio really determines whether these things are a long-term vehicle. You know, the higher the expense ratio, really the less likely is that you want to hold this for a long period of time. And in fact, ETFs, you've got to be careful with ETFs for a very long period of time because that expense ratio will eat into your returns. But when it's a really high expense ratio, you've got to use it for short-term stuff. So QQQs are good, lots of liquidity in those. Great for intraday trading as well because of liquidity. Great for kind of swing trades, that kind of stuff. You know, you're getting exposure to the NASDAQ. There's loads of assets under management in it. It's just a good, simple alternative to trading NASDAQ futures or a spread bet or a CFD. Okay, now, and obviously if you bought that ETF, you'd be bullish. If you shorted that ETF, you'd be bearish. We'll talk about that in a moment a bit more. The other thing you can get is the TQQQ. Now, much less asset under management, higher expense ratio. So you're not looking at this to hold this for a long period of time, but what this does offer is it offers you triple leverage. So what it means is it tries to, and again, you've got to read perspectives with ETFs, guys. You've got to trade ETFs. You've got to understand the ETF you're trading. But generally what it's trying to do is return 3 times the amount of the underlying. So if the NASDAQ 100 goes up by 1%, this should go up by 3%. There are some risks in that. Sometimes it doesn't always do that, but most of the time, that's what it's trying to achieve. Same with the downside. So you've got to watch out how you trade that. Now, you'd buy this if you were ultra bullish in the market, you wanted triple leverage on it. This was the sort of thing you'd buy maybe for a few day hold. You thought the NASDAQ 100 was going up. You wanted to get the most bang for your buck. Of course, you're going to get the risk that goes on the other side of the sword with that. The double-edged sword, you know, you get good return for your investment because it's going up 3 times the amount, but also you can lose 3 times the amount. But if you're prepared to do that, then that might be one you want to look at. And then we've got QLD. So QLD is basically this pretty much the same, except that it's a double ETF. So in other words, it returns twice the amount of the NASDAQ 100. So if you're not quite as aggressive with the triple, you don't want to go with the single QQQ, you might want to go with the double, which is QLD. 1.64 billion under management. Again, reasonably high expense ratio, so you don't want to be holding this for a long period of time. Okay, now we look at some of the other ones, and these other ones are a short ETF. So in other words, they're inverse. So an inverse ETF basically looks to inverse the performance of the underlying. So if the NASDAQ 100 goes up, then the inverses will go down. So this is handy. Why would you use an inverse? The inverse is if you're looking for a short position in the market, but you want to buy an ETF. So let's say you've got a wrapper where you can only buy stocks, or you can only buy ETFs, you can't actually take a short positions on anything. Then you can buy one of these inverse ETFs and make money from the market going down. So if you just have a simple stock portfolio, stock account that you can buy ETFs and stocks in, you might want to hedge your portfolio by just buying one of these inverse, because that means that you're going to make money as the market goes lower on that ETF that you're going to lose on your stock. So, you know, there's ways of doing that. Of course, if you're just speculating on a down move, again, you can move to these. So the standard one we've got, which is just 1 times the leverage. So in other words, if the market goes down by 1%, then this will go up by 1%. That's PSQ. Very little assets under management. Liquidity is a little bit low with these guys. As you start to go down to these, liquidity starts to get a little bit low. So you got to be careful if you're day trading these in terms of the spread, in terms of all those kind of stuff where you can get out of position and sort of position size you want. So watch out for that. Look at the difference, 87 billion for the Qs, all the way down to kind of 300 million for QID. So that's something to be aware of as well. So if you want inverse, but just single leverage, PSQ, you want double leverage, you go for the QID. If you want triple leverage inversed, so let's remind ourselves what that is. If the market goes down by 1%, that should go up by 3%. I say should because there's some caveats to that, but that's what they aim to achieve. And that's got 1.5 billion assets under management, 0.95% expense ratio, so not something that you want to hold for a long period of time. But if you've got a thesis, for example, you think there's going to be a couple of weeks worth of selling in the market, and you want to really leverage yourself up, and let's say you've got a stock portfolio, you want to hedge that, you've only got, you want to use a little bit of money for that, then you might go for something like this that gives you that exposure, bigger exposure for a small amount of outlay to cover your hedge, or to hedge your risk, should I say, or to speculate. And again, you can dial it down for the double or just go for the single inverse ETF. So loads of, and there's other ones out there as well, guys. These are some of the main ones. If you want to get exposure to the NASDAQ, you're bullish, you're bearish, you're hyper aggressive, you're a little bit aggressive, there's something for everybody out there. But just watch out, guys. Make sure you read and understand what you're actually trading. There have been instances where ETFs have just gone to zero. Some of these, and admittedly, they were VIX-based ETFs, so a little bit different, less likely with some of these. But you just got to be careful because there are some inherent extra risks with ETFs that aren't necessarily there with underlying stocks. You've got to be careful as well that you understand the compounding effect of inverse ETFs and the compounding effect of the triple leverage and double leverage, because it's not quite as simple sometimes. Don't forget it's day to day they're doing that. And then working out which one's the best for you. So the beautiful thing is loads of options out there for traders, speculators. It's just picking the right one for your thesis and for the conditions you're trading in and for the wrapper that you're trading in as well. All right, guys, take care. See you in the next one. Bye-bye.